Now, generally, on most days, we use something called the 10% rule. Now, the 10% rule is where you'll put on an out-of-the-money butterfly and make sure that the debit is only 10% of the width of one of the wings. And then we would, of course, get the biggest net that we possibly can. In most cases, that's going to be somewhere between a 30 and 40 wide fly per side. So a 30 wide would be a total net width of 60 points, and a 40 wide would be a total net of 80 points. So that's pretty wide, and that's a pretty big net to cast, and hopefully that the price will end up there. And it's really a timing game. The timing game is that we have this event that happens at 2 o'clock. At 4 o'clock, the market's going to be closed. Now, there are a couple of things that are happening in between then and then. So we have volatility rising into this event, and so that's our opportunity to actually lay down the trap or put on the trade, because as volatility rises, that allows us to get the best price possible, the smallest amount of debt for the maximum amount of premium. So that's generally what we're doing. So we wait for that volatility to rise, we put on the strategy, we put it out as far as we can, and then we just sit there and wait for the trap to be set. Once 2 o'clock comes, a little bit of churn and everything, because at 2 o'clock with the FOMC, the minutes are released, and with the minutes is generally a textual report. And so all of the AI and linguistics experts are consuming that report, and that's attached to all kinds of algorithms, and it's devised, and then that's set up or set to push buttons on trading programs. And so that goes off, and then once that's done, then volatility starts dropping off. And if we set our trap right, then we'll start seeing premium starting to explode inside of these butterflies, and you can collect some profit. If nothing happens, or if the response is muted, then there's really nothing to do. You're not going to get the movement. It doesn't get near your fly, and you just sit there and wait. Now, with an event like today, it's actually two-pronged. So we have that first event potential, but then there's the follow-on. At 2:30, there's often a presser where Chairman Powell will get up in front of the press corps, and then they'll start drilling him with questions. Now, sometimes those questions or the time allotted are very limited. So you're looking at the chart right now, you can see that price has dropped. This is Tesla. All right, here's the market. So we can see that the presser started at 2:30, which would have been right about here. So it first started right around here, and it was up and down. It initially went down, and then apparently he said some things that the market liked, and it went up, and now it's gone down, so the market doesn't like what he's saying now, so now it's down. And the range since Powell has been on is from 39.72 all the way up to 40.39. So that's kind of interesting. Almost a 70-point range. Is that right? Yep, 70-point range, about a 70-point range. So that's obviously at 40% greater than the expected move had predicted, which was only about a 50-point range. So now we can see price going up again. He must have been asked a good question and given a good answer, and now it's going up. So yeah, it's going to be a roller coaster ride like that. And I don't know. We might end up breaking this session high, or we might end up breaking this session low, or we might end up right back in the middle, which would be probably a big downer for everybody, because then there's no opportunity to profit. So, that's what we are faced with when we're putting on these trades. And so we want to be as flexible as we possibly can. We have no idea where it's going to go, so we'll put on a market neutral or a market agnostic trade. And with 0 DTE, we have essentially two choices for trades. We have a single fly or a double fly. We call the single fly the classic fly, and that's the classic out-of-the-money asymmetric trade using the 10% rule. And that's what we do most days. And on days that we feel like there's a good opportunity for catching a trend. These days, recently, it's been the best choice to choose a market neutral trade, and that's where we take two of these classic flies, one above the market, one below it. Then it creates this dual thing that looks like Batman's ears, so we call it the Batman trade. And so that's what we might do here on Fed Day. Put one above, one below, and hopefully one of them will catch the move. Now, when we do that, we have to make sure that our cost is in line, because now we're putting on two flies. Do we want to go with the 10% rule on both of them and then essentially have double the risk? Because we don't know if it's going to go one way or the other. There is an outside chance that we could profit on one, and then it comes back and then we profit on the other. That has happened before. And that is typical also with Fed speeches like this, where the market is just going nuts up and down. But I don't know. The answer is that we don't know what's going to happen. So the logical conclusion is to take as little risk as we possibly can. So instead of, say, going to a risk to reward of 1 to 10, we might go to 1 to 15 or 1 to 20, which would mean that the total amount of risk that we would take versus the spread, instead of being 10%, we might drop that down to 7 or 5 or even 3. Now, what that means also is that we're pushing the flies further out, way out. So the probability of profit is less. And we're taking an appropriate risk for that, pushing them further out. Now, if we're expecting an extreme amount of volatility, even though we push them way out like that, you can still hit it right on the mark. As an example, just a couple of weeks ago, I put on a trade that was 40 wide and only 5% of the total risk, of the total width. So that was a 1 to 20 or 1 to 18 risk to reward. So for every $1, I could potentially make $18. And what happened there is that price did move all the way to the fly and then slightly inside of it. And so for a $200 risk, I received $2,100 in profit. And so that was really cool. Now, when it moves out like that, at one point it was up to $2,700, quite frankly. But so there you can see that even though a trade looks like it's so far out of the money that there's no way, in fact, on that day, I put up at $200 and made $2,100. Actually, the largest return that I've had so far in this account, this reference account for the service. So it's always possible.